Hello everyone and welcome back. Today we are talking about a question I hear all the time from real estate investors. Should I buy my next rental property in my own name or should I put it in an LLC? And usually when people ask this question, they're expecting a simple answer. They're hoping there is a magic rule that says LLC is always better. Here is the truth. The answer is it depends, like we answer a lot when it comes to taxes and accounting. It depends. And making the wrong decision can cost you thousands of dollars, create financing headaches, or leave you with less protection than you thought you had. So let's clear up some of the confusion. First, let's talk about the biggest myth. A lot of investors believe that buying a rental property through an LLC automatically creates huge tax benefit. Most of the time, that's simply not true. If you own a single member LLC, the IRS usually ignores the LLC for tax purposes. The rental income and expense still show up on your personal tax return exactly the same way as if you would have owned this property personally. So if someone told you put it in LLC because you will pay less taxes, that's usually not the reason to do it. The tax treatment is often identical. Now, does that mean LLCs are useless? Not at all. The real reason investors use LLC is usually for liability protection. Imagine a tenant slips on an icy walkway and files a lawsuit. Or maybe there is an injury on the property. Or maybe there is a dispute involving tenant, contractor, vendors, neighbors. Many investors like having a legal entity between themselves and the property because it can help create a layer of separation between personal assets and rental activity. Notice I said can help. LLC not a magic force field. You still need the proper insurance. You still need to treat LLC correctly, operate LLC correctly. You still need a legal advice. But liability protection is usually the primary reason why people consider LLC for rentals. Now, here is where things get interesting. Let's say you are buying your very first rental property. Many investors discovered that lenders often prefer lending to individuals rather than newly formed LLC. In fact, sometimes you will get better rates, better terms, lower down payment requirements, and an easier approval process when purchasing personal. I have seen investors create an LLC before talking to a lender and then accidentally make financing much more difficult. That's why I always tell people talk to your lender for making ownership decision. The financing side matters a lot. Now let's discuss another mistake. Some investors that every property should have their own LLC. Other investors hear that rentals should be grouped together. The reality is there is no one size fits all answer. If you have one small rental, your structure might look completely different than someone having 10 properties across multiple states. As your portfolio grows, the conversation becomes less about taxes, more about asset protection, risk management, estate planning, financing flexibility, and long-term strategy in general. So that's why copying what someone said on YouTube usually is a bad idea. Their situation is probably completely different from yours. Another thing investors don't realize is that moving a property into after you have already purchased it can create complications. You may have lender issues, you may have title issues, you may have state-specific considerations. So ideally, you want to think about ownership structure before closing on the property rather than trying to fix it afterward. Now, if you're wondering what we typically look at when helping clients make this type of decision, and we start with a few questions. What's the value of the property? How much liability exposure do exist? How many rentals you already own? What state your property is located in? How are you financing it? What's your long-term investment plan? And what actually you are trying to accomplish in general. So because some answer is buying personally, sometimes the best answer is buying it through an LLC, and sometimes the best answer is actually a more advanced structure and title. The key is making a strategic decision before the purchase, not after. Because once you have closed, changing things later is usually more expensive and more complicated. And this is exactly why proactive tax planning is very important. Most investors spend weeks looking for the perfect property, but they spend about 30 seconds thinking about how they should actually own it. Yet the ownership structure can impact taxes, liability protection, financing, and future flexibility for years to come. Before we wrap it up, I've got a question for you. If you're planning to buy another rental property this year, are you thinking about purchasing it personally or through an LLC? Drop it in the comment and let me know. And if you're not completely sure whether your current ownership structure makes sense, that's exactly the kind of thing we help our clients with. Sometimes we find that everything is set up perfectly. Sometimes we find opportunities to improve structure before the next acquisition. Either way, it's much better to find out now than after you have closed another deal. Okay, thanks for joining me today, and I will see you next week for yet another tax savings strategy that can help you to keep more of what you have earned. And as always, I put together a free rental property ownership decision checklist that walks you through the key questions to consider before buying your next property. So whether you are looking at buying it personally or through LLC, this checklist will help you to make this decision the right way. Just comment the checklist, even if you're watching it on a replay, and I will send it your way. Bye for now.